Ashley Murphy, CFP, GFP, AIF, CEPA, a bit of alphabet stew there. Financial planner focused on the needs of Australians and Americans in Australia and those in transition. I really want to be clear here. This is such an important topic with massive tax consequences that are potentially irreversible. So this is absolutely not to be considered personal advice. This is general advice relating to these cross-border matters. But there's a friend and mentor of mine who says you'd be crazy to rely on this unless you were a client of mine, where we are considering the factors of your personal situation in providing that advice. Feel free to subscribe to our YouTube channel. I've got a whole host of webinars that are up there. I've been recording these for the past 5 years at least, and there's a whole bunch of them that are available there. A little bit about me. So I am a tri-citizen of the US, UK, and Australia. I was raised here in Brisbane, Australia, moved to the United States in 2005, where I thought to myself, well, I thought a couple of things. I thought maybe I should be a financial planner. That's what I was really destined to become. And surely there's got to be some sort of book or group or website or something dedicated to helping those with cross-border financial planning problems. Turns out there wasn't, and it was for that reason I founded the Global Financial Planning Institute, where I and my team train other financial planners in the matters that we will be talking about today, and a whole lot more. I'm a regular conference speaker on the US financial planning circuit, given this expertise that I have. The sorts of clients and the issues that we work with are listed here, as you can see. And let's get into today's presentation. So here's a broad outline. So first, it's important that we go through and define these terms. We need to look at the definitions of legal versus tax residency, what the tax treatment of a non-US citizens, what that looks like, what the situs of an asset means, what the source of income means, and the consequences of becoming or remaining a US tax resident. Next, we'll move on to the major decisions. As far as I see, there's really two major decisions to be made, and they are to bring a non-US spouse into the US financial system or remain in the US financial system. And the second one is who holds what assets where. Now, with those thoughts in mind, we'll then proceed to the third section, strategies to make the most of one's mixed nationality status. So essentially, who holds what where, what assets to hold where, trusts and businesses, and gifting of highly appreciated assets to non-US spouses. So let's get into it. Okay, first subsection here, key concepts and definitions. So I went through this last month, but it's so important to cover off on this every time this presentation is given, because nothing else makes sense if these points aren't clear in your head. So US immigration laws, legal immigration statuses are quite different to tax statuses. So when we look at legal residency, you're either one of four of these legal statuses. You're either a US citizen, a permanent or conditional resident, that would be your otherwise known as green card holders. You're a non-immigrant, you're here on a visa of some kind, which is saying your intention is not to move permanently necessarily. Or fourth would be undocumented. Everyone, 100% of people fall into those four categories. Next, there's tax residency. Now, this is really important here because a lot of people aren't clear in their head. They say, no, I'm just a visa holder. Doesn't matter. If you are in the US and pass one of two tests, then you are considered a US tax resident. And those two tests are the substantial presence test, and that would be if you're in the US more than 183 days in the present year, or a declining formula in the prior 3 years, you're a US tax resident. Doesn't matter what your legal status is. Does not matter what your legal status is. The other alternative would be if you're a green card holder. The fact that the second test there, the green card holder or citizen, is so important is because that follows you anywhere. The US is unique in the developed world in that if you are a US citizen or green card holder, no matter where you are in the world, be it or out of the world, we heard Jeff Bezos just went to space yesterday, Wouldn't have mattered if he was, I'm saying that just tongue in cheek, but wouldn't have mattered if he'd stayed out there for a whole year. Uncle Sam is saying, you're a US citizen, congratulations. We want to assess you and have you report on what are your US income and assets. And we'll go into that in just a moment, actually, as to what all that reporting actually is. But that's the key thing. Compared with Australia, if you are an Australian citizen and you move overseas, with the exception of your Australian sourced income, and we'll define source in just a moment, and that would be things like trusts, businesses, real estate, and with the exception of that, the ATO says, well, you're not here, it's not really, and you don't have earned income from employment from Australia, not really fair that we tax you when you're not actually here. The US doesn't see it like that. So that's an important distinction right there. Tax residency. So let's go a little deeper here, pull away a layer of the onion, talk about what is the tax treatment of non-US citizens. Well, really, it's as simple as this. It falls into two categories. You've either got your resident aliens, and that's the charming term that's used. These aren't my terms of art here. They're the generally accepted nomenclature when referring to non-US citizens. You're either a resident alien, basically means you're taxed almost the same as a US citizen. There is a really important difference that we'll get onto a little bit later. We're not going to touch on it in a great amount of detail, but it's to do with gift limits. And the annual gift limit between two US citizen spouses is unlimited. It's unlimited. You can give $1 million to your spouse, no problem if you're US citizens. If, however, you have a non-citizen spouse and you're in the US, let's say a green card holder, married to a US citizen, well, there's an annual limit. And that annual limit in 2021 is, I believe it's $159,000 that may be gifted. And that's an important number for us to remember because we're going to come back to it later, to do with strategies and who should own what where in order to get the best tax outcome. The other important thing to consider as a resident alien, done a whole webinar on this, and it's a huge topic unto itself, and that would be the Hart Act and whether any exit tax is owed. So if you have been in the United States for 8 of the past 15 years, then you fail one of 3 tests that are applied, then you would be deemed a covered expatriate and subject potentially to an exit tax from the US when you leave. It's not the end of the world. There is quite a complicated calculation that needs to be done, but thankfully there is a pretty generous, I believe it's about $750,000 capital gain exclusion, so that's nice. But retirement accounts and other types of property are not treated so well. They're deemed distributed on the date of that expatriation, and so there can be a tax impact, but it totally depends on the composition of someone's wealth. Next, we've got non-resident aliens. So you're either in the US and you're an alien, or you're not in the US and you're still an alien, a non-resident alien. So the tax treatment for them is a little different, a little more complicated. And that is essentially they're only taxed, again, on this concept of source, on US sourced income. The term is ECI, if you want to go and research that for yourself, effectively connected income. And it's a vague term because certain things that you would think are effectively connected sometimes turn out to not be. And I'm thinking specifically of businesses here. So if you own stock in a company, it may be deemed to not be, if it's a publicly listed company, may not be ECI, effectively connected. But if you own your own closely held business, then of course that's going to be effectively connected income. So the non-resident alien is only taxed on their US Situs and sourced income. We'll talk about Situs also in just a moment. Okay, source of income. This is the important definition that I wanted to show you here. So the source of the income is essentially where that income came from. It's a self-descriptive term right there, the source of the income. And it's important. It's an important concept because it determines which country gets first taxing rights on that income and whether perhaps any additional tax is owed. Where today's presentation gets interesting is as you are aware, I am interested in my clients in the intersection between Australia and the US. If we talk about these things generally, it gets a whole lot more complicated because there are basic rules, but those basic rules are overruled in the presence of tax treaties. And so we really need to focus what we're talking about here with regards to the Australia-US tax treaty and what the applicable treatment is of any income source. But we'll see in just a moment here the example that I've got describing source of income. So we have a couple living in the US, doesn't matter what their legal status is, by the way, in this example, and they own an Australian investment property. That investment property, of course, it's not making any money because that rarely is the case on so-called investment property in Australia. And it's considered Australian sourced income. Why is that? Because real estate, businesses and trusts are considered Situs of that particular country. And so despite being primary US tax residents, that property owner would need to file an Australian tax return because they have income that is sourced, that is generated from Australia. So the US will also want to know about that because they would assess whether any additional income is to be paid on that. And let's not forget at the state level too, the states also have that global income purview. So there may be additional state tax owed as well. So that's the concept of source. Now we move on to situs. Source and situs are closely interconnected. Situs tends to come up more in the concept of estate planning. And you'll see that here with the very first bullet point I have. So non-resident aliens, i.e. non-US persons, to use nicer language, are subject to transfer taxes only on their US situs assets. So transfer taxes, that covers a swath of different kinds of taxes, but mostly we're concerned with gift tax and estate tax in transfer tax. The word transfer, moving from one party to another, so gift tax or estate tax on US situs assets. So let's say we have a US couple living in Australia, a US citizen married to a non-US, an Australian citizen, and they own an investment property back in the US, excuse me, the Australian resident owns a property back in the US. That Australian person dies. Well, lo and behold, the US is going to be very interested in the value of that property because it is a US situs asset and it's going to transfer from the deceased to, presumably, to the spouse. Is there a taxable event that may occur in that transaction? Possibly. That's where things get tricky, by the way, and there's a whole nother presentation I have coming up to do with estate planning for Australians and Americans because of the presence of an estate tax treaty and how things are processed there. But in today's presentation, I'll be talking about the QDOT, the Qualified Domestic Trust, which is a way of avoiding the worst and the pernicious effects of US estate tax treatment on non-resident aliens, which is very nasty. It's $60,000. So in other words, if a non-resident alien holds property in the US with a value of more than $60,000, there's going to be a 40% estate tax owed on that transfer. Given the context of Australia and the treaty there, it could be different. Like I said, we'll hold that for another time. So tangible property is always considered US situs. What else is there? There's a whole bunch of other things here. It doesn't make a whole lot of sense, by the way. It's not as if there's some rational reason we could point to say why it is that stocks and ADRs of US companies are US situs, but cash isn't. Or life insurance is another one. It's not, there you go, death benefit of a US life insurance policy is not considered US situs. But these various other things over here are. Again, this is important with the concept of transfer taxes. Okay, so I know this is a lot coming at you very, very quickly, but we have a short amount of time together. So consequences of being a US tax resident. I mention this because if one is in a situation where they have a choice of going one way or the other, then you'll want to be mindful of what you're signing up for and make sure that the benefits mostly the ability to file married filing jointly, which is going to be particularly beneficial to higher income earners, is present. It's funny that with the Biden administration tax proposals, there really is a sweet spot, if you will. If you get above that, then the married filing joint suddenly becomes disadvantageous again. There is a proposal slowly working its way through, and that is for income earners, married filing joint or single, doesn't matter, above $1 million will be taxed at the highest marginal rate. So that's that, and that in turn itself is presently 37, but reverting, the proposal is to revert to 39.6. So if you get above that level, you're actually in a situation where capital gains are going to be much more highly taxed in the US than what they would be by Australia, by the ATO, where it's half of your marginal rate. So 45% being the top marginal rate, half of that, 22.5, a significant difference. We'll talk about tax brackets in just a minute before I cover off here on the consequences of being a US tax resident. So firstly, you've got the reporting issues. This FATCA and FBAR, is that the end of the world? No, it's a hassle, it's a nuisance, but it does mean that you're on a constant 6-month reporting cycle because the tax years don't align. End of Australian tax year, as we all know, June 30th, end of the US tax year, December 31st. So you're having to file on these things. They're mostly informational, but here's the trick is they have to be accurate, they have to be right, and the penalties are astonishing if they're wrong. And I mean astonishing. 50%, in the case of FBARs, there's a slew of examples of where individuals have willfully not disclosed foreign accounts, and they end up with a penalty of 50% of the account value. Yes, 50% of the account value is claimed as a penalty by the US. So that's quite significant. Next one, which is also of massive significance, is PFICs, Passive Foreign Investment Corporations. It's a rule, came into effect in 1986 in the Reagan administration, Tax Reform Act of 1986. And it was intended to put a level playing field for the US investment industry. And what it's really done, it didn't simply levelize, it actually has acted as a wholly protectionist move towards the US investment industry. And here's why. Because if you have a foreign investment, and they use two definitions, it's more than 50% of the assets are passive in nature, or 75% of income is held, produced is passive in nature, you have yourself a PFIC. And what are the consequences of that? There's what happens to most people, and that's the do nothing. The do nothing rule, and the do nothing rule means that you're taxed at the highest marginal rate, going back to that 39.6% rate we spoke about a moment ago. You're taxed at that rate for every year where you had a distribution above the 5-year average. It is complicated, and in fact, that's actually one of an equal disadvantage of PFICs is not simply the higher tax. No one likes paying the higher tax. The reporting of these is horrible. I mean horrible. In the IRS's own assessment, they say it takes 12 hours or more per PFIC to complete the filing properly. And that's every year. So that's not only do you have to report on it, but then there's possibly higher taxes. So the simple way to get around it, there's really two simple ways to get around it, one of which is suboptimal, in my opinion. First way is simply don't invest outside the US. Just don't do it. That is one way around it. I don't think that works in reality, though, especially for couples and families who have decided to re-domicile out of the US. If they've moved overseas, they intend on living the rest of their lives overseas, there's a currency mismatch. If your bills and your assets and your expenses are incurred in a native currency, there's fluctuations all the time. In fact, we've just seen a major decrease in the Australian dollar versus the US dollar occur over the past few weeks. We're now down at around 73.3. Something like that. If you're on the wrong side of that move, you just found in the space of about 6 weeks, all of your bills just went up by 6-7%. So that's something we need to be really mindful of, is that currency mismatch. The other issue that the other approach I was going to say for dealing with PFICs is what's called a separately managed account approach. And that the way there is you own individual stocks. So a US tax resident would own individual stocks overseas, and individual stocks are not considered PFICs. If, let's say, you own Telstra or QBE or something like that, these are operating companies that are participating in the business that they're in, and they're not considered PFICs. So that's the other approach, but that's very tricky because now you've got to figure out what stocks to buy, at what price, how much, how do you create a diversified portfolio, et cetera, et cetera. So that's very problematic, is the second one, PFICs. Next is treatment of foreign retirement plans. Well, this is where PFICs come into it again. I have done a webinar on this as well, how the US treats superannuation. But it's not so simple. It's either an employee trust or a foreign grantor trust. The employee trust, not so bad, still kind of a nuisance. Again, it's going to massively add to your tax filing to have to do it in the first place, versus the foreign grantor trust, where the individual has made more than 50% of the account contribution and has a greater discretionary investment control. Now you've got yourself more tax problems, because not only are the contributions to that superannuation account not recognized as tax deductible by the IRS, but the gains in that foreign grantor trust are taxable on an annual mark-to-market basis. Thankfully, that means you get a step up in basis when it comes out. It's going to be a return of capital, but nevertheless, this is the antithesis, the opposite of what you want to typically see in your higher income earning years. You don't want to be paying tax, those highest marginal rates. You want to be paying at the lower marginal rates, which is one of the main benefits and points of contributing to retirement accounts in the first place, is that you're playing tax bracket arbitrage. You're taking that deduction now in order to pay tax at a lower bracket when you're retired. Net investment income tax. So this is a 3.8% surtax that kicks in above certain income levels: 250,000 married filing joint, 200,000 single. So it's an additional tax intended to cover healthcare related expenses in the US. Next, so just as a reminder here, folks, this is the consequences of being a US tax resident. So no matter where you are, if you're in the US tax system, you got to worry about all of these things. Treatment of foreign trusts. The US doesn't necessarily recognize these foreign trusts. And again, we can talk more about that in an estate planning webinar. But essentially, if a trustee, or if the laws of the trust are not US, then it's a foreign trust, and these punitive interpretations would apply. Businesses, bad news. And following these webinars, I always get a flurry of emails that come to me about business owners, Americans abroad, and they might not be aware of controlled foreign corporation rules. And that is where you have a US shareholder who's more than a 10% shareholder of that company. And now there's a whole bunch of additional reporting that needs to go on as a result of that. And last but certainly not least would be the HART Act. If a green card holder, and that's that long-term aid of the past 15 years, fail one of the 3 tests, they'll be considered a covered expat. There may be an exit tax owing. So those two, these 2 slides here really document what we see as the major, consequences of being a US tax resident. So let's move on from here. So these are all the things we need to be mindful of. We need to be mindful of legal versus tax residency, source of income, treatment of non-US tax treatment of non-US persons, source of income, situs of income, and consequences of situs of assets, and the consequences of being a US tax resident. Now that we're clear on all of those points, what are the major decisions that we need to make here? Really, I've done a lot of research into this, and it boils down to these 2 points, in my opinion, for Australian Americans. And that is to bring the non-US spouse into the US financial system or not, or to keep them in there, as is commonly the case as well, or who holds what assets where. Those are really the 2 major decisions. And I would love to make a decision tree and help folks figure this out. We haven't done that for today's presentation, but that's something I'd like to do in the future. So to bring that non-US spouse into the US system, or to remain in the US system, it's a personal decision. Everyone's situation is going to be a little bit different. That decision needs to be made in light of tax resident status. So obviously we're dealing with Australian tax residents here with the addressable audience of this presentation. So that is important mostly because the federal rate of tax in Australia is higher than that of the US. That means, in large part, you're probably not going to get a separate tax bill from the US from most kinds of income, especially given the presence of foreign tax credits. The trouble, well, I should say the trouble, the thing, the gotcha, if you will, the cherry bomb with the foreign tax credits is that they're suspended. They can't be used to offset US income. They can only be used to offset foreign source income. So if you were to move to the UAE or Vanuatu or Cook Islands or Bermuda or somewhere like that, then you would be able to use those foreign tax credits. But if you're not planning on doing that, then it may be of little benefit. So the tax resident statuses, so Australia, US, and maybe somewhere else. Where the couple currently lives and where they plan to retire, we're going to assume that the addressable audience here is either living in Australia or the US, and they're planning on retiring probably in this case to Australia, because there wouldn't be the luxury of choice of the non-US spouse opting out of the US system if they were to remain in the US. That decision has already been made for you by virtue of, as we spoke about before, the substantial presence test and the green card test. So you would already be a US tax resident. Decision made. That's the end of the story. Relative incomes of the couple. Do you have a situation where you have a breadwinning spouse who makes a lot more money than the other spouse? More importantly, is that likely to continue outside of the US? We don't really care about that so much. It could be the case that we have a couple that make approximately the same amount of money. They're intending on retiring, or one is intending on retiring, the other maybe semi-retiring, then moving overseas, and then you would have a situation with a big income disparity. That's another factor that needs to be considered here. Relative wealth holdings, i.e. in whose name are the assets currently held? Is there much of a difference there? Future inheritances or future gifts, or it really doesn't matter where that's coming from, if that's going to change that relative wealth holding and upset the apple cart of what the financial plan, the investment plan is for that couple going forward. And the personal attitudes towards sharing. I mean, this is an approach. The philosophy that we're talking about here is one where we really need the couple to be on board with the kind of sharing that happens here. If you file a married filing joint tax return, then you are jointly and severally liable for the statements of what's on that tax return. Simple as that. So you've got to be comfortable shouldering that risk. And also understanding that in the event of relationship breakdown, there will also be protocols to be followed in making sure that there's an even and fair distribution of that estate. So these are all things to be considered. Let's talk about a really simple example. We've got Chris and Pat. Chris, 52, is an Australian citizen, married to Pat, a US citizen, Australian permanent resident. So they're opposites of each other. Australian citizen, US permanent resident, and Pat here, the US citizen, Australian permanent resident. They live in New York and plan on retiring to Australia in the next few years. Very common situation. Together, they own an apartment worth $2 million that's jointly titled. They own an assortment of investment accounts worth $2 million and retirement accounts also worth $2 million. Chris must decide whether she will attempt to become a US citizen before leaving the United States, or surrender her green card once in Australia. Those are really the two choices there, because there's the 2-year limit that Chris will encounter upon being overseas. However, without that Form I-407 filed, that would mean that despite Chris's formal immigration-based status changing, the tax residency still hasn't changed until that form is filed, surrendering their ongoing US tax liabilities. So that's the big decision to be made here. Also, Chris expects to inherit $3 million from her family in the future. Interesting. So I'm just going to talk at a very high level of the issues that I see when I look at this. Okay, the sale of the apartment. let's think about that. What is the basis of that? Because here we have a difference between Australia and the US. In Australia, we have an unlimited capital gain exemption on real estate. And with how crazy the real estate market's been, that's been a benefit to many individuals. In the US, not so much. We have $250,000 for single, $500,000 for married filing joint, provided you've been living in that property for 2 of the past 5 years. Just had a client that they sold their property in Amsterdam, that they moved out of 3 years and 3 months ago. And the advice there was, well, and they had a sizable gain on it, you will get prorated the proportion of that period of time where you were present and that was your primary residence, and you'll have a little bit of tax to pay because it's been over that 3-year period, so 2 of the past 5 years. So there's a difference there. If they sell the property beforehand and the gain is less than 500,000, congratulations, there won't be any capital gain. What if they move to Australia and the gain was more than 500,000? Well, suddenly you've got the US there's so much conditional logic when talking about these situations. Let's say Chris here opts out, surrenders his green cards, no longer in the US system, then they sell the house from abroad. Well, depending on the tax filing status, which we're going to have to assume is married filing separate, there's only a $250,000 exemption that Pat would be able to use because Chris is no longer in the US system. So that's the first issue that I see when I think about is the timing and the tax residency of the individuals at the time of the sale of the house. Next, an assortment of investment accounts. This is probably the most, I'd say, common situation you'd see is who owns what where and what's the basis of these assets. So if you have a situation where Chris is thinking about getting out of the US system, remember, we only have $159,000 annual marital gift exemption that we can use. Might it be possible that Pat could gift over to Chris some of these assets? That would be a really good strategy, I would think, if that situation holds. Other than that, not a whole lot else to say. There's kind of a tax trick that can be performed here that would be worthwhile. It's also worth mentioning here, it's not subject of today's presentation, but do keep in mind that if you surrender your green card or even go so far as relinquishing your US citizenship, it has no effect at all on your Social Security status. So you'd still be able to receive Social Security, which is something some people wonder from time to time. Now, as for retirement accounts, this is interesting. So retirement accounts, as we all know, they're all individual. There's no such thing as a joint retirement account in the US or anywhere else that I'm aware of, other than maybe a self-managed super fund with multiple members, but even then you've got individual contributions there. So the retirement accounts are going to be individual, and there's not much that can be done to change that. What can be done, however, with a bit of planning and foresight, if a solid decision is made as to what Chris's US status is going to be going forward, then we might be able to employ the tax treaty to Chris's advantage on that move. And what would that advantage be? Coming up in a moment in recommended strategies. And it's all to do with the tax basis of that asset and what Australia deems it to be. And Chris expects to inherit $3 million from her family in the future. Interesting. So there's no immediate taxable consequence of that inheritance to Chris, even if she were to become a US citizen. It's just that now that's going to be factored into future transfer situations. So we've got the current estate tax exemption is about 11.5 million US dollars with spousal portability, meaning if one spouse dies, the other gets the unused exemption amount from the deceased spouse. So a pretty high amount, but that also is in flux. That could change. And if it changes and it reverts back to what it was just a few years ago, down around the $5.3 million level, and before that it was at 3.5, and before that it was at 2, suddenly $3 million could come into play. It could be an asset that is subject to US gift and estate tax. So that's what I see when I look at that situation. So when to opt a non-US spouse into the US tax system? The main advantage, as I see it, is attaining married filing joint tax status. And we'll go in just a moment. I see, sorry, a little typo right here. We'll go in just a minute and look at what those numbers actually are, but that's really what I see. Remember, you can, well, for clients of mine, we can open US brokerage accounts from abroad, so that's not an advantage or disadvantage. The Australia-US tax treaty provides pretty good treatment. There's no major disadvantage or any disadvantage that I can see from an Australian non-US person having a US brokerage account. So it really, as far as I can tell, it boils down to this: married filing joint. So what are these differences? Let's compare single to married filing separate. So we want our eyes follow down this column here and compare it to the married filing separate. Before we do that, however, let's keep in mind that for single and married filing joint, it's pretty much double all the way down. It's double, double, double. And then when you get to the higher income amounts, it's not double. There's a little bit of a true up that happens. But the thing we need to notice here is look at the difference of the higher income amounts, the high tax brackets, 35, 37. What's happening between single and married filing separate? You go from 207 to 518 as a single filer, and that's your 35% bracket. Well, for married filing separate, they get cut about $207,000. They hit the 37% bracket way back at 311 as compared with 518. And let's see what happens a little further on here. The 37 as well, obviously they're in the 37% bracket above that 311 versus 518. So married filing separate, in addition to those punitive tax rates, there's also a host of other credits and exemptions that are foregone with that tax filing status. So it is a nasty tax filing status. Invariably on internet forums, look on Facebook, on these expat groups, and you'll see people that don't know what they're doing or talking about maybe we should file married filing separate because of this advantage or that advantage. It won't affect my student loan or whatever. Almost never does it make sense. So therefore, what we're really talking about is, should we opt the non-US spouse in to get married filing joint tax status going forward? Well, maybe, depending on if the US person really is the breadwinner and there is an intention of moving back to the US, I would say that's a fact pattern that probably holds. But where it wouldn't make sense would be if they're unlikely to move back to the US. So now you've just brought that spouse into a lifetime of US reporting. That's not without its costs, both in time and money. If you've got a breadwinner who will earn above the foreign earned income exclusion and resides in a low tax or no tax jurisdiction, not the case in Australia. I'm just saying that's another scenario where we could see that would be a big disadvantage if you're in Dubai, for instance, or the whole host of other lower tax, Hong Kong's another one, lower tax jurisdictions than Australia. Then that would be a big mistake to do that, because you've just opted someone in to suddenly be on the hook for paying a bunch of tax that they would not have otherwise had to pay. Or much more commonly, this is probably the most common, this is what we'd see, is you have the person who has the choice to remain in the US system or opt out, having a considerable amount of the couple's wealth where those investments could possibly be deemed as PFICs. They're a major shareholder in a foreign company. They're the beneficiary of a non-US trust, or they may receive a significant inheritance or a large change in their financial situation in the future. If those things are the case, that's going to weigh on that decision. There is the 6013G election. This is a once in a lifetime, doesn't even matter if you get divorced. This is a once in a lifetime election for that non-US spouse to opt into the US system. So this is the form that's completed that accomplishes that outcome. So who holds what where? So given the implications of the US tax system, as well as the cost and difficulty in attributing income to a non-resident alien spouse for jointly titled assets, let me back up a second. There's a mouthful just there in what I said. Let's say the US citizen spouse and the non-citizen spouse own a joint investment account in Australia. Okay, if the non-citizen spouse stays outside of the US tax system, then how is the IRS going to attribute gains, income and gains from that account? Well, it's going to be complicated. And wherever there's complication, there's cost, because you're now talking about CPAs having to figure it out and attribute who gets what where. So, and that goes to the heart of this point: who holds what asset where, and for what reason. So, thought and planning needs to go into that particular decision. You'll note, by the way, in case you feel I'm not making recommendations or providing my commentary, that's because of the way the presentation is structured. So I'm getting into that right now. So the strategies to make the most of the mixed nationality status would really boil down to these two things here: asset placement and account titling. So asset placement and account titling, what are we talking about here? There's a big move to be made, and it totally depends on your facts and circumstances. But what we need to be mindful of is that the ATO doesn't consider assets acquired abroad until you move back to Australia. And what basis do they assign them? They say, well, we really don't know what you bought it for, or what it was worth prior to you moving here. But now that you're here, welcome, we're going to say it's worth whatever the fair market value of that asset is on the date that you resume Australian tax residency. And this is where, right here, is where there is a massive opportunity for a positive tax outcome. If you can move assets into a person, a non-U.S. taxed or not tax residency, just to stretch the limits of grammar there, individual's name, then they get the step up in, effectively a step up in basis, because they've escaped the US system. They're now in Australia. Australia has said, we don't know what you bought it for, but we know it's worth this now. So if that individual was interested in diversifying their portfolio and selling that asset, they could do that for no capital gains, which is huge. That's absolutely huge. That also affects retirement accounts as well. So if you had someone that had saved over the course of their career into a 401k or 403b or IRA in the US, then they moved to Australia, relinquished their US personhood, their US status. The ATO looks at this and says, well, we don't know what this account is. We certainly don't think it's a superannuation account. We think it's a foreign trust. And the way we think foreign trust should be taxed is the employee and employer contribution form the basis of the trust, and any growth that you have on top of that is taxable as ordinary income when distributed in Australia. There are some other moves that we can employ when we get back to Australia to do with superannuation that could possibly bring that taxable gain all the way back down to nothing, or significantly reduce it. So that's another really attractive tax move that could happen there. The thing with talking about taxes is that people's ears tend to perk up, because tax savings are certain savings, but I am a big believer that in human capital value, in that the value of our time is truly not a renewable resource. And if you're having to deal with this for the rest of your life with US taxes, and the fear that someday you might be audited by the IRS and have a whole bunch of tax to pay, then it's just, there's got to be a way to quantify that particular stress. So the non-US spouse is better placed from a tax perspective in owning certain kinds of assets because they step out of the US system. We're thinking of foreign investments, namely, if one were to own a diversified portfolio, a diversified investment account in Australia, owning ETFs or managed funds, that would be considered a PFIC if it were in the name of the US person, but it's not if they're outside of the US system. So that's a nice one there. Foreign businesses, we've got the controlled foreign corporation rules there, and the reporting that goes on with that. And it's not just reporting; it's much worse than that. It's undistributed gains from that CFC are taxed by the US. So you have the possibility of phantom income. If you had a business that made a large profit in one year, but that profit was kept within the entity, the US says, we don't care if it was kept within the entity. It's a controlled foreign corporation as far as we see it, and you're going to pay us a bunch of tax on that. The other thing is foreign trusts. So the ATO doesn't, sorry, the IRS, excuse me. The IRS, as I mentioned earlier, they don't have much time for trusts that are not administered or set up according to US law or have US trustees. They're foreign trusts. They look through it and they'll tax it on a mark-to-market basis, which could eliminate a lot of the benefit of an Australian family trust where a US person is part of that trust. So much to consider here. It's like three-dimensional chess. So spousal gifting, what do we have here? The main thing I want to focus on is this lifetime gifting to non-US citizen spouses. So you heard me say earlier, there's the 11.7 million estate tax exclusion. That might not even come into it, to be honest, won't for most people, unless you're talking about high net worth families. It's not going to come into it. It could change, could be halved or even greater than halved. So maybe it would be, it's a moving target to watch in the future. But we're not too worried about estate taxes, also given the treaty that Australia has with the US on that front. But what we are concerned with is gift taxes, where there's this $159,000 annual limit. And so that is one that we need to be mindful of. So the creme de la creme strategy would be gifting low basis, high appreciation assets out of the name of the US person to the non-US spouse prior to them relinquishing that US status. So on the date of that expatriation, let's say for 5 years, we've gifted, that would be close to $800,000 worth of low basis holdings into that person's name, which could be saving, again, tens of thousands of dollars in capital gains taxes. So that's a nice strategy there. QDOTs, again, whether that comes into it or not versus the tax treaty, that's a subject for another presentation. But that really rounds it out for today. So I want to stop and open up the floor and see if anyone has any questions here that I'd be happy to answer. We have a raised hand. Hi, Antonia. How are you? Or maybe the hand continues to be raised. I'm not sure if you just raised it, but feel free to chat in. There should be a panel. There'll be a Q&A panel and a chat panel. I don't really mind where the questions come from, but feel free to send it in. Oh, it was left up from before. Okay. I suspect that this is a topic where people's heads are probably spinning. They have so many questions, they don't even know where to start. So don't be afraid. This is your opportunity to get these questions out. All right, not a lot showing up here. We'll just give it a minute before we wrap up then for today. Antonia, can the US tax inheritance received by the Australian? Well, depends on if they retain their US personhood. So if in one situation, if they happened to be a green card holder, they moved back to Australia, surrendered that green card, paid whatever exit tax needed to be handled, then they would not have to worry about that. That would be outside of the US system. If the beneficiary was their US citizen husband, however, there would be a Form 3520 gift tax form that would need to be completed, but no real tax, no real implication from that. It just becomes intertwined or involved in the US system where it might not need to be. Eric writes, a question about married couples with one spouse in the US and the other in Australia. Okay. Can the US state their attempt to tax the Australian income? Question about married couples with one spouse in the US. The missing part of that question, Eric, is the U.S. tax residency status of that married partner who's in Australia, and the titling of the asset. So there's two things there. Is that person that's in Australia a U.S. tax resident? Are they a dual citizen, or are they still a permanent resident who hasn't filed an I-407? If that's the case, then they're going to be brought into the U.S. system. Or let's say they're not, they're just an individual, an Australian tax resident, they have nothing to do with the U.S. Oh, U.S. citizen in Australia. Well, that changes everything. Thank you for clarifying that point. That simplifies that. Then yes, they would need to file a U.S. tax return. Whether or not the U.S. actually will hit them for additional tax, that's another matter. Probably not in all circumstances. Probably not. But nevertheless, it's a hassle, and there are a few pitfalls and mines with that. And then U.S. state tax, yeah, that depends. That gets really tricky actually right there, because it actually depends on a state-by-state basis. So if you're dealing with, say, Minnesota or New York, they have a more of a definition that follows along the residency lines, whereas California, for instance, follows along the domicile line. So perhaps the spouse, Eric, that remains behind in the U.S. still owns their family home, and that the citizen, the U.S. citizen in Australia, is there temporarily. Then that state, assuming California in that case, practicing the domicile approach, would still very much tax them. And then as for how many other assets are taxed, that's honestly, I think that's going to be so specific to the individual. That's really, really a complicated thing that you need to look at. Income and asset. Figured as much. Yeah, it's going to be super specific down to who earned what income where, what state is the individual in, and what's their definition of tax residency, and so forth. Antonia, hi Antonia. Is married filing separately ever advantageous for the couple with is it ever advantageous? The only time I've ever seen it, I'm sure others may have other situations that they've seen, but the only time I've ever seen it is with student loans. And even then it's a little bit dodgy because of income-based repayments. If you do married filing separate and someone has a really low income, then that's gonna be an advantage right there. Other than that, Antonia, I can rarely think of a situation that's positive. But then again, I would also encourage you to get your own personal advice on that matter. I don't mean to be flippant on that. I just mean there's just so many moving parts. I don't want to for you to act on that based on my comment here. Madeline, I'm going to swap back to the Q&A because Madeline did put that in there in the Q&A before Tim wrote in. Madeline, thank you for this. I'm an Australian citizen and a US visa holder. Great. Not a green card, an O1. Fantastic. Talented individual, Madeline. That's what the O1 tells us about that particular visa category. Married to a US citizen. We currently live in the US but plan to live and retire in Australia. We just bought property in the US. Okay. Well, in whose name? Is it jointly titled? That's the first thing I want to know. We want to sell this property and use the capital gain to buy in Australia. What's the most clever way to do this? Okay, it's joint. Thank you. Well, it would depending on that gain amount, it would likely be to sell that while you're still in the US to get the $500,000 capital gain exemption. Where I've seen this done really successfully was with a client of mine, my longest term client. When we first met, they said, we want to move to Germany in 8 years' time. And they moved just a year or two ago. And what they did is they sold their house immediately before moving to take advantage of that $500,000 capital gain exemption for the primary residence. The term of closing was that they would rent back from the new owner for, I think it was 3 or 4 months. And then they had their cash ready, undertook a systematic conversion process so that they didn't get on the wrong side of the exchange rate if there was any major fluctuations over that period of time, and then purchased in Australia once they arrived. There's also things that can be done with regards to obtaining mortgages from abroad, where that would make sense to take advantage of that before you arrive as well, where you might be able to get the benefit of a higher US income, and possibly, you know, have a house identified before you technically arrive in Australia. So maybe you could do an exploratory trip to scope out neighborhoods and so forth before actually committing to financing that and getting that in place before you even leave. Tim, I'm a US citizen living in Australia for the last 6 years. Okay. Considering rescinding citizenship, well, you're in good company here. John Richardson is on the line here today. Are you suggesting an exit tax would be likely on something like capital gains from home in Australia? No, I know that the US primary residence exemption does extend internationally. So depending on the amount of gain you have would be the answer to that question. So I don't know if you're single or married filing joint. So it's either going to be 250 or 500,000 US dollars. So I couldn't say, but that's the factor that comes in here for a home in Australia. What about after the 7 years? You mentioned an 8-year rule. Well, you're a US citizen. That doesn't really, so that the long-term US resident pertains to green card holders. So as a US citizen, that doesn't matter. So rescinding your citizenship, that's obviously a very big decision, and I'm not here to opine on that one way or the other. But I would say you become you will be deemed a covered expat automatically by being a US citizen who is relinquishing, and then whether an exit tax or not is assessable is based on 3 tests. One, are you up with your US and state tax filings for the past 5 years? Did you have a federal average tax bill of 168, I think it is, of the last 5 years? And do you have a global net worth of more than 2 million US dollars, which is what captures most? Remember the $168,000 I just quoted, that's a tax bill, not income. So a lot of folks will make more than that in income, but you're really going to be earning about $800,000 before you have a federal tax bill of $168,000. So that it's really the third test, that $2 million global net worth in retirement accounts, real estate trusts. Are you the signatory on a trust where you could potentially direct assets in your direction? If you are, all of these things will come into play, and they could be part of an exit tax for you. Okay, and then Antonio had that follow-on there with one unemployed spouse. I think my point would hold, and that I've rarely ever seen that make any sense, but it is a very complex field. Thank you, Tim. It is a very, very complex field and highly personalized, as I'm sure you've seen in today's presentation. I want to thank you all for coming. It's an honor that you're here, and I love sharing my information and knowledge about this area. And so I want to thank you, and this will be made available on YouTube within about 24 hours. And folks that didn't make it today will be notified of that. So thank you very much, and have a wonderful day. And you're welcome, Madeline.